Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, joining me is author of How to Invest in Gold and Silver and the creator of Gold Silver Data website, Don Durrett. Don, thank you for joining us here today.
Thank you for having me, Jason.
Thanks, Don. Glad to finally be speaking with you. Now, Don, I want you to talk a little bit about your background for our listeners here because you're on, your third edition now of your book, How to Invest in Gold and Silver, and could you just tell our listeners a little bit about your background and what led you to start investing in gold and silver and start researching it and, before you started putting any capital into the sector?
Sure. I started investing in gold mutual funds in the early 1990s. I did that for a decade. And after I got to a certain point, building up my portfolio in mutual funds, I decided to start investing in mining stocks, specifically junior mining stocks. And at that time, I did some research, and I couldn't find any books on the subject. So I ended up having to learn on my own, which took me about 5 years. And I'm an author. I've self-published 9 books. So after I learned how to invest in gold and silver mining shares, I decided to go ahead and write my own book on the subject.
Sorry to interrupt you, Don. That's great. I mean, I've looked at some of the other books out there, and a lot of the older ones, like you said, when you first started, a lot of them are very technical. A lot of them are written, for geologists by geologists.
Yes, correct. It was amazing to me how I came up with my own system. My system is basically a 10-step approach, and on my webpage I have a YouTube video that goes over those 10 steps. And in my book, the junior chapter is 70 pages long. And the reason why it's so long is because there's so many different data points that you have to analyze and understand in order to make correct decisions. If you don't understand all of the little minute little details in investing in junior mining stocks or even mid-tiers or majors, you're going to make mistakes. And so I think it actually takes about 2 years to learn how to do this, to learn all the little data points and know what they mean. And that's one of the things that I've been doing. I consider myself an educator with my books. One of the reasons why I keep coming out with new editions every year. Somebody told me to keep the book fresh. But not only am I keeping the book fresh, but I'm expanding, helping people to understand all the various data points so they make good decisions.
Yeah, and I think you're doing a really good job. Your website provides a lot of valuable insights, and you have all the chart stuff in there. It's in kind of an Excel file, and you have the different comments about different parts of the company and how to analyze them. And I think it's really good from the perspective, besides just actually giving people fish, you're teaching people how to fish. Like you said, you enjoy actually educating people, not just handing them, free fish.
Exactly. I created a database. When I was getting ready to do the second release of my book, I recognized all the various data points, and I realized that if I put that in a database and allow people to have access to it, would help them. And the data on my database, there's approximately 60 columns per company, and I have 430 companies in my database, 300 of them with ratings. So there's a lot of data there. But the data, that's a starting point for people, but they need to know what to look for. It's knowing what to look for that's probably more important.
Exactly. And I've been investing in this sector for over 3 years now, for about 4 years, and that includes, other types of commodities like copper stocks, which was one of my largest percentage gains. Was I bought a copper mining stock right after the market crashed really bad. I bought Lundin Mining around 30 cents a share, and, I did some of the valuation analysis that you did, and the stock, like 18 months later, went over $5. So this is, I can attest that when you learn this skill, it is very valuable, provided you learn to protect yourself from yourself and you don't, bet no matter how good the risk reward looks or the valuations are in one stock, you protect yourself from yourself by diversifying.
Oh, definitely. In my book, I talk about using a pyramid approach, and I use that myself in investing. And what I mean by the pyramid approach is the foundation should be the lower risk stocks. For example, the foundation is Bullion. There's three tiers in the pyramid. The bottom tier is Bullion ETFs, major mining stocks, and gold mutual funds. And I have 50% of my portfolio in that bottom tier. So I think it's important that you definitely create a foundation, but then you work up the pyramid in order to take advantage of this bull market. So the middle tier, I have mid-tier mining stocks, and then junior mining stocks, both explorers and producers. And the very top is options. I talk about how you have to be very careful in that top tier as the risk goes up. But yes, it's important that you manage risk.
Yeah. Now talking with some of our listeners who have commented, and we did co-author a Treasure Hunting for Precious Metal Stocks report, which was informational, educational too, besides just stock picks. Talking about the macroeconomic situation, talking about different asset classes, and why we think the real estate, a lot of real estate investments are not a good investment right now. Why the bond market is probably the worst investment right now, but in general, these junior mining stocks, it's just the volatility in general from them. I've heard other commentators talk about naked shorting in them. I've heard, when the financings are done with some of them and, the lockup period expires and the people go and sell the shares, what are some of the ways you yourself mitigate some of these risks?
I have a system, and I think that my system, I invented it, and I think that my system works. Basically, I have 8 different categories that I use to analyze data points. Each category, what you're doing is you're identifying red flags. And you try to identify all those red flags by stepping through this system, the step-by-step approach. And then after that, after you have all the red flags, once you know the story of that company, then number 9, the 9th step is to find the valuation. Hopefully you're looking at a low valuation. And then the last step, step 10, is you give that company a rating. So the rating encompasses both the red flags and the valuation. So when you put all that together, you're going to have a very good feeling about the upside potential of that stock and the risk level of that stock. So when you build your portfolio, you're going to have a good idea of what your risk level is, what each stock represents, and you're also going to know what your upside potential is. For example, I give you one example. For example, Andina Minerals is the highest rated company that I have in my database. I have it rated at 4.5. My rating system goes from 1 to 5. Mm-hmm. Each rating point is based on the potential growth of that company, the future growth. So we look at Andina, for example. It has a 10 million ounce resource in Chile. And they've given guidance where they're going to produce 250,000 ounces in 2015. Now, the project's 100% owned, and they have 18 million in cash. The fully diluted shares is 132 million. So it gives them a market cap of $112 million. So we're looking at a market cap of 112 million, and they're going to be producing 250,000 ounces of gold. That right off, I mean, if you're an investor, you know that there's a disconnect there. That's a very undervalued stock. So I look at all the red flags. I go through all of my steps. For example, Andina. I look at this. I could just name off the first 8. The first one is properties. The next one is people and management. The third is share structure. The fourth is location. The fifth is projected growth. The sixth is the chart, stock chart. 7th is the cost structure. The 8th is the cash debt situation. So each one of those, I have various data points. So then, after I look at all the red flags, for Andina, they have very few red flags. The only 3 red flags that I've identified is a takeover possibility. Since it's such a great opportunity for somebody to buy, it's so cheap. I mean, you're going to have 10 million ounces of gold in the ground. Plus, they've given guidance to find another 2 million, so they're looking at 12 million ounce resource. I have future reserves I have valued at $9 an ounce. So it's really, really cheap. So you have takeover risk. There's a possibility someone's going to take it over, so you're not going to get the big return. You're only going to get maybe 50, 75% return if somebody takes it over. The other one is the financing. They're going to begin construction next year, but they haven't gotten all financing yet. So there's a little bit of risk there. The other one is the political risk in Chile, which I think is somewhat minor, but they did have an issue down there with Bear Creek. So there is some. So we have 3 red flags. So, but on the whole, there's very few red flags for Andina. Now, the way that I look at the rating is I use the future. I calculate a future market cap. This is a theoretical future market cap. So I take the reserves, which are 10 million. Well, I'm converting the resources into potential reserves at 10 million. This is a future market cap, and my horizon is 3 to 5 years down the road. I don't look at 1 or 2 years. That's just not far enough out. So I'm looking at about 3 years down the road. So I take the 10 million and I multiply it by a future gold price, which I have it at $2,500. And I multiply that by 20%, which is the maximum in situ value that I'm looking at. That gives me $5 billion. So the potential future market cap, this is the highest that I think it's going to be, is $5 billion in 3 to 5 years. Then I compare that to their current fully diluted market cap, which is $112 million, and that comes out to 4,300%, or what I call a potential 40 bagger. Now, in my system, I only go up to a 5 rating is a likely 10 bagger. That's as high up as I go. But for Andina, I gave him a rating of 4.5. So what I'm looking there is I'm combining both the upside potential and I'm combining the risk, and it gives me a rating. So what I try to do is I try to invest in companies that have ratings of 3 or higher. Because since I have a very solid foundation of low-risk stocks, now I'm investing for companies that have higher potential. So I'm looking at stocks with a rating of 3. Now, a rating of 3 is a potential 5 bagger. A 3.5 is a likely 5 bagger. So I'm trying to find companies that I can identify 3, 3.5, or 4, and I build my portfolio. And that's what I'm trying to teach people to do.
Yeah, and I think that's great there. And these are for people, who don't want to go and buy the GDX, the GDXJ, or the SIL, because those are the benchmarks that you are comparing your portfolio of juniors against, right?
Exactly. And I tell people, I recommend do not invest in companies that have ratings below 3.0 at this time, because you can invest in ETFs that are going to get you the same return and much lower risk. For example, today SIL's trading, which is a silver mining stock ETF, it's trading around $25. So at present day, I don't see the reason to invest in a silver mining company that has a rating of 2.5 or below when you have SIL available. Now, down the road, once SIL goes up, if SIL goes up to like $40, then the companies that have a 2.5 rating come back into the picture. A 2.5 is a likely 3-bagger, and right now I think that SIL is a likely 3-bagger, so that's what I recommend, that people kind of avoid companies that you analyze and you look at their potential upside growth, their potential upside potential, and you kind of avoid those stocks. Or I also recommend investing as a foundation in some of those ETFs. For example, I have a big investment in SIL, and I think that GDXJ and JLDX are both very good ETFs for a foundation and for a potential 300% return.
Now, Don, I want to ask you your opinion about the differences between investing in physical bullion and the mining shares, specifically the producers. For the most part, really since 2008, the real price of gold didn't start going up until after the market crashed. The Rogers Raw Material Index, physical gold was only able to buy before the market crash of 2008, I believe about 15% of the whole Rogers Raw Material Index, which is all the different commodities. And then after that, gold has now increased to over 40% purchasing power of the Rogers Raw Material Index. So basically the real price of gold has tripled. That has slowly started in the last couple of years to trickle down to the bottom lines now for a lot of the gold and silver producers, and they're finally, their profit margins have, for a lot of gold miners, they've doubled, and, you just have a lot of free cash flow. So my question to you is, the mining stocks have underperformed for the most part for a good amount of time in the last, couple of years. Do you see this changing, or do you think with a lower, lower valuations here for some of these junior explorers or some of these junior producers that just started going into production, do you see these larger guys coming in and swallowing a lot of them?
I definitely do. I think this question we could spend 30 minutes on. I personally think that you started off the question with bullion, so I want to talk about bullion. I actually think that gold bullion is not an investment. I know that over the weekend, Warren Buffett has been getting a lot of play because he was saying that he wouldn't invest in gold versus agricultural land or Exxon. Well, that's not the question. Investing in gold bullion is not an investment. Investing in gold bullion is an insurance policy. For instance, people buy health insurance, or they buy car insurance or homeowners insurance, and they're insurance against a loss. Well, that's what gold is. It's a savings plan. You're investing in gold bullion to maintain your wealth. That's all it's for. It's not an investment. Silver bullion, on the other hand, is an investment because silver, I guess we can talk a little bit about silver and we can talk about the upside on it. For example, 1945, there were 10 billion ounces of bullion and coins formed. Today, there's 1 billion. So 90% of the bullion has basically gone away. So we have approximately 1 billion ounces of silver above ground in bullion or coin form, versus gold, which you have approximately 2 billion ounces of bullion and coins. So there's twice as much gold above ground as silver. Also, silver is becoming more and more used in manufacturing, and anything that has a wire in it, basically, because silver is the best conductor, is used for silver. All of your new green energy is being used for silver. They're finding new uses for silver every day. That's the reason why the inventory is so tiny above ground. So silver is an investment just because it's rarer than gold, believe it or not. And so the other thing is the amount of silver that's available to be purchased. Right now, okay, we have about 1 billion ounces of silver above ground, but how much of that is actually available, physical, for purchase? Well, 50% right off the top is sitting in warehouses in ETFs. Another 10% is held by the COMEX, but that isn't available. Most of that's not available for purchase. It's held for other individual owners of that silver. And then you have privately held silver, which is a lot of that is not available, which is probably another 20%. So the amount of silver that's actually available for purchase above ground is probably only about 100 million ounces, and that's spread out all across the planet on various distributors that have it, or small stores. So the amount of physical silver is just tiny. The potential for a shortage is a very high possibility. For instance, just 5 years ago, the amount of silver and the demand was only about 20% of all the annual demand. About 80% was going into fabrication, into products. Well, now it's up to 25%. Now, 3/4 is going into fabrication products, and 25% is going into investors and coins. You can see that dynamic is changing. So as investors want more physical silver, that percentage of demand is going up. If it gets to 30%, we could see a shortage. So I see silver more as an investment. Even silver bullion. If you're buying silver bullion today at $35, I mean, we're looking at potential silver down the road at $150. So it's definitely an investment. You also asked about the cash flow for the majors. Yeah, definitely. The cash flow is going crazy right now. The PEs are shrinking. So the potential for stocks to go up is truly, this is a really good entry point, in my opinion. For instance, I just did an analysis on Anglo Gold, and their cash flow doubled from $1.3 billion to $2.6 billion in 1 year. That's huge. So these companies are getting an incredible cash flow right now. I think the majors are going to lead the market. I think once we see the majors break out, I think then everybody else is going to follow. And once we get to $2,000 gold and $2,500 gold, the stocks are going to do really well. So the opportunity, I think, right now is a real good time to get in. Now, that said, I think that we're going to see a stock market crash. We can talk about the global economy a little bit, reasons why I think that's going to happen. And when we get that crash, you're going to see the stocks get hammered, but it's going to be a short period of time. So if you're investing today, for example, SIL's at 25, I think we could see SIL in the teens by the end of the year. So that you are taking some risk investing today at the stock market where it's at 13,000. So you're taking a little bit of risk there because I think the stock market is very frothy. Sorry for the long answer.
Yeah, and I would agree with some of your global macroeconomic assessment here, because we see the capital market. What I see is a tale of two different stories. I see the capital market saying that the global economy looks pretty good, stock prices are going up, but then I look at the real economy, especially here in the United States, and I see things getting way worse. Now I know the ECRI people are saying that we're definitely in a recession, and the CNBC people are fighting with them. But, the signs to me that I see in the real economy here in the U.S., I see basically stagflation in the real economy. I see the real unemployment rate increasing. I see, consumer staples prices going up. I see food and energy prices going up. And I don't see that changing anytime soon, especially with the decisions that are going on by the Federal Reserve and the politicians in both parties.
Right. Yeah, let's talk a little bit why people should invest in gold and silver. Let's talk a little bit about the global macro. First thing I want to do is I wanted to give a plug. Last night on Zero Hedge, there was mentioned a new YouTube video by Grant Williams. If you go on there and you search for his name, Grant Williams, and then Simplicity, it's about 20-minute video talking about the reasons why to invest in gold. He does a real good job. So let's talk a little about the reason why it makes sense to invest in gold and silver. Starting in 1980, we've had basically a debt wave in this country. In 1980, the United States government debt was less than $1 trillion. Today it's 15, so that's a 15-fold increase in 30 years. Now, the government led the way with this debt wave, of course, and this is the Ronald Reagan era back in the early 80s, 82, 83, 84. That's when our deficits really exploded. At that time in the mid-80s, I was very concerned, saying this is not a good direction we're going in, adding debt, thinking we can get away with it. Now, 30 years later, it's caught up to us. Now, it wasn't just the government that did this. It was also corporate debt. If you look at the percentage of corporate debt in 1980 versus today, it's increased dramatically. A lot of people say that the corporations have lots of cash in their books, but that's very misleading. When you add up all the corporate debt, in many respects, especially the financial system, the debt is a big burden in the banking system. It's making, you're seeing less money work its way into the economy for that reason. The balance sheets on a lot of these financial institutions are not good. Then if you look at the families, the family debt in 1980, the total family debt was 25% of the debt versus they have today. It was 25% of GDP, in 1980. Today it's 100%. So families, by and large, are over-leveraged. So you add up all this debt, and it's not a good situation. Now, the key thing to understand is why we added all that debt. The reason why we added all that debt is because the U.S. economy quit generating wealth in abundance in approximately 1972. That's in 1972 is when our manufacturing industry peaked, and then it started shrinking from 1972 to today. It used to be over 20% of the workforce was in manufacturing-related jobs. Today it's about 10%. And so we're not generating the kind of wealth. And so since we weren't generating the wealth, we utilized debt to maintain our standard of living. And this is a very important point. When we look back in history, we're going to see where America utilized debt to maintain a standard of living when they shouldn't have done it. And it's really going to hurt us in the near term, I think, and especially the long term. So since we're using debt to maintain our standard of living, we've created an illusion of a strong economy. And that is what is really going to get us. For example, the U.S. dollar, which is the global reserve, is one of the reasons why we've been able to do this. Foreigners have basically been subsidizing our standard of living for the last 30 years. And now it's starting to show itself. We're starting to see more countries start to, for example, go away from the petrodollar, try to buy oil and other foreign currencies. Foreigners have not lost their appetite to purchase our debt yet. But if they do, and I think it's going to happen, if they lose their appetite, once that happens, interest rates will have to rise. And we can't afford interest rates to rise. So the ramifications are quite dramatic. And if this happens, there will likely be a run to gold. Well, we're in a trend towards a run to gold. But right now, who's participating? Less than 3% of the American populace is participating in this gold bull market. And of that 3%, I would say only 1% has a large percentage of their assets in gold. That's, say, 25%. So the participation rate is very small in gold. If you go look in the last two bubbles, for example, the real estate market, the participation rate was probably well over 10% of the American population in that. And then if you talk about people that are just homeowners, their valuations of homes going up, they participated in it because they spend their money in other ways. So in addition to the participation rate, you also have, if you go and you look at the 1990s where you had the internet bubble, the participation rate was significant. And you don't have that participation rate in gold yet. So you don't have the bubble yet. The bubble hasn't happened. We haven't had
So sorry to interrupt. Yeah, I completely agree. And, you know, there's just no signs, in my opinion, that we're anywhere near bubble level. In fact, like, you know, a lot of my friends before, you know, I woke up and started learning all this stuff. A lot of my friends I used to hang out with now, a lot of them think I'm crazy still. None of them would ever touch gold. Some of them, you know, went to top business schools, and they did learn economics. And, you know, everyone still has that paradigm shift, that mindset where gold is a barbarous relic, where, you know, it's not smart to buy any gold. And, you know, people are going to learn the hard way.
Yeah, what people, you know, especially Mr. Buffett needs to realize is that he even talked about the small quantities of gold. So gold represents, it represents something that's very rare. It's actually the perfect form of holding something that holds its value. There's so many properties of gold. It doesn't blemish. You know, it's basically indestructible. It's highly liquid. I mean, it has all these values of something that would be the ideal asset. When we're talking about fiat money, we're talking about, okay, what can we hold as a hedge versus that fiat risk? For example, right now, if you look at the United States, Europe, and Japan, if you put all three of those countries together, they all have a serious debt situation. So, okay, they have a debt situation, so they have a fiat problem. They have a fiat money problem to go along with that debt situation. So people are going to have to make a choice. Do we hold on to this fiat money as it loses its value? And we're seeing it lose its value quite rapidly. Or do they make some type of a change? For instance, if you're holding cash or fiat-related assets, for example, the bond market. The bond market is about a $50 trillion market globally. Well, if you start to feel as an investor that those bonds are not safe, what are you going to run to? Well, if you run to gold, gold's going to go up dramatically in value. So it's a very smart hedge for that situation occurring. I actually think that there's so many different things that can happen, so many black swans. One of them is, again, I talked about people no longer wanting to hold dollars and no longer wanting to invest in our bond auctions. So that's a possibility. People no longer wanting our currency. The other one is not just the U.S. dollar, but the bond market, the global bond market. People leaving their own bonds, for example, leaving the Japanese bonds and going towards gold, or getting out of some of the ECB bonds in Europe and going to gold. So you have the bond market is huge, $50 trillion, and the gold market is only $3 trillion when you talk about the physical market. I mean, some people talk about it being $10 trillion, but a lot of that is in jewelry. 50% is in jewelry. So the actual market is much smaller than that. I know that Buffett, I think he mentioned $10 trillion. Well, that's very misleading. That's not the total gold market. I think the gold market is more like $3 trillion today. So if people say, okay, where do I want to put my money? Plus, people like to follow trends. Bubbles are true. So you're going to see more of a run to gold, a run to silver. I think that the American public is not really going to get too interested in gold yet until we have a bit of a crisis. I think, you know, $2,000 gold or possibly the stock market going down, you're going to see more people run to gold. I wanted to make one final point about the global macro. The consumer's tapped out, in my opinion. You don't have growth, for example, in the economy. So consumers don't have any extra free cash flow to get growth going. You have high taxes for small businesses. Businesses are having a hard time right now making money. You have all of your small businesses are impacted by financial issues. For example, there's fewer loans being given out today. Then you have high energy prices, for example, peak oil. 2005, we really had peak oil. When you're talking about the stuff we put into refineries, it was about 74 million barrels a day. We've been on a plateau now for 7 years, and that plateau is about to drop. And in tandem with the peak oil, you also have peak exports. People don't realize this. We focus on the total energy supply. Energy supply has been growing at about 1% rate, but most of that 1% rate has been natural gas, but oil hasn't been growing. And at the same time, exports, and this is the number that we really need to focus on, global exports of oil have been shrinking since 2005. The next one is new technologies. We don't have, what's the new bubble? What's the new technology? You know, the only thing that we're seeing really is phones. You know, Apple with their iPhones and their iPads, and then some, you know, internet companies. But on the whole, we don't have a new technology that's going to grow the economy to get us out of this problem.
And I don't think we can grow our way out of this problem, Don, because the debts, especially in the U.S., are compounding. The debt is the national debt is growing at 11% compounded interest rate per year. So, you know, 11%. When was the last time the U.S.'s real GDP grew at 11% rate? That was, you know, well over 100 years ago. So it's not mathematically possible now because of how fast, you know, negative compound interest rates, how fast the debt is now growing on itself.
Right. This is a point that Grant Williams makes in his video. He talks about the monetary base exploding in value. If you look at the monetary base in 1980 when gold got up to $850 versus today, the growth has been incredible, especially the last 3 years. Well, since 2008, the monetary base has been exploding. Well, that monetary base, it equates to the value of gold. They go hand in hand. So if you look at 850 was a very small number versus where we're at today. And then you have to equate two things. You have to equate both the increase in the monetary base, but you also have to add inflation as well. So it's almost exponential. So the potential for gold to go to $5,000 is very real, because of what you said about this monetary base explosion.
Yeah, and I think the world central bankers, especially the Federal Reserve, if they can't get the inflation that they want, you know, with the currency wars and the other things that are happening to create the inflation that they want, if they can't get it through the normal ways, and Ben Bernanke has alluded to this in a 2002 speech, their nuclear option, in my opinion, is they will devalue the dollar. They won't allow, you know, the beneficial purchasing power of the fiat money, of the dollar and other fiat currencies to increase. So what they will do then is they will probably do some kind of bank holiday, and then they will just devalue the dollar against gold, move the gold price up to, you know, $5,000 an ounce overnight, and then that'll create the inflationary expectations that the central bankers, the Keynesian and MMT people want, who are making the policy decisions, economic policy decisions in the government.
You're singing my tune, Jason. I've been predicting a devaluation of the dollar. I think that's the only solution to this problem. I don't know when it's going to happen. I think it's going to happen before 2015. I think your bank holiday is right. I think they will close down banking system, and when they reopen it, you have to convert your dollars into the new dollar, and I think it will be devalued. So one of the reasons why I think that people should be insuring themselves with gold, because if you do have a devaluation, let's say you have a 30% devaluation, you could wake up one morning and have, if you're dollar heavy, you could have a net wealth down 30%. It's very real. I'm glad that we got this chance to talk about the global. Usually I just talk about all my system and all my investing. I didn't wanted to make the point to people that even though we didn't talk today about my system, about how to analyze stocks, you can watch my YouTube video that goes step by step on each of the various ways to analyze companies, all the various data points. Also, I have an article on my webpage that you can read as well, and then my book. So I do explain how if you want to invest in gold and silver mining stocks, especially juniors, and you want to know how to value them, you want to know how to analyze them and have confidence, I have plenty of information to help you educate you on that.
And Don, for our listeners, one more time here as we wrap up the interview, can you just give our listeners the URL, the website to go find your your research work for the gold and silver juniors, and tell them where they can find your book too?
Yes, the webpage is goldsilverdata.com, just one word, and there's a link on my webpage to a couple of reviews and explains what my book is, and then the book is for sale at Amazon, BarnesandNoble.com.
Well, in wrapping things up here, Don, I just want to thank you for your time today, and you provided some very great insights and a pretty good stock pick, I would say, for our listeners out there. So definitely, go. Can
we do 2 more stock picks? I'll be nice to people today.
Okay, sure.
All right. Thanks for the time. Since you did mention that one stock pick, I had 2 others I wanted to give out. The first one is Arvista Gold. Arvista Gold is a relatively new company in Canada. They have a 2 million ounce resource. And retail only owns 5%, and there's only 55 million outstanding shares. So it's a very tight structure. Plus, they have a good management team. It's on 27,000 acres, and they have 5 drilling areas. I have the future reserves at 3 million, and you calculate that out. You take the 3 million times the future gold price of $2,500 times 20%, gives it a potential future market cap of $1.5 billion. They have a current market cap of $16 million. So that gives it a potential return of 9,300%, which is almost a 100-bagger. The only red flags on this is the timeline risk. They're probably not going to start producing gold until probably 2018, which is a significant timeline risk. It's actually a little bit outside of my range. I like to go only to 5 years. 2017 was really as far as I want to go. We don't have a PEA yet, preliminary economic assessment, but on the whole, it looks like a really strong. On my website, actually, I have 8 potential 50 baggers, and Arvista is one of my favorite potential 50 baggers. I think it has a lot of upside potential there. So that's one. It has significant risk, of course, because 2018 is a significant timeline risk before they begin producing. But that was Arvista Gold. The other one is Wits Gold. Now, Wits Gold has 150 million ounces of resources in South Africa. Now, 120 million of those are inferred, but that still gives them 30 million of measured and indicated. It has a market cap of only $200 million. Their first mine is going to come online, is scheduled to come online in 2014. So that's only 2 years from now, and it's projected to produce 200,000 ounces. And then in 2016, they're going to bring another mine online that's going to produce 150,000. And that mine has 10 million. So between the first 2 mines, they have 24 million ounces of gold reserves, well, measured and indicated. And they're going to produce 350,000 ounces. So what is 350,000 ounces of production going to be worth in, say, 2016 if gold is, say, over $3,000 an ounce? Well, it very likely could be, a $2 billion plus company. Well, the current market cap is $200 million. So Wits Gold is one of those ones that's very highly undervalued. I have it as a potential 25-bagger long term. The only significant risk on Wits Gold is South Africa. There's potential for nationalization. There's a lot of rumors, a lot of talk that South Africa might nationalize their mines. So you have that risk there. But if you're comfortable in South Africa, Wits Gold might be a good play. Those are my 2 other stocks, Jason.
Yeah, and that is a very good point about South. Hello?
I'm here.
Yeah, and that is a very good thing you brought up about South Africa is the geopolitics of South Africa. And I don't think anyone knows for sure what's going to happen. South Africa also has some power problems on their grid. A lot of the companies that operate exclusively out of there, their production costs have been rising very rapidly because for a number of decades there was a tremendous amount of underinvestment in their power grid.
Right.
So South Africa, personally, I'm only invested in one company that has any type of exposure whatsoever to South Africa, and they actually mine rare earths, and then they process the rare earths outside of South Africa, so the majority of their profits are not made in South Africa.
Okay. Yeah, you make a good point. Number 4 on my stack list is location. And you were just talking all about location, all the potential issues in South Africa. Now, I actually you want to limit your exposure. When you're creating your portfolio, you want to limit your exposure to companies that are not in mining-friendly areas. And South Africa is one of the ones that has a little bit higher risk, and everything that Jason said is absolutely correct. You have potential nationalization, potential electrical energy cost higher. But Wits Gold is one of those ones that some of your portfolio you can go outside of the mining-friendly areas. Now, the 8 mining-friendly areas that I currently look at is Canada, Mexico, Australia, Brazil, Colombia, Argentina, Guyana, and then 2 states, Idaho and Nevada. If I have a company that has all of their properties in those 8 locations, then I consider that fine. I don't consider that I'm exposed to risk. Anywhere else in the world, the risk goes up. For example, in South America, you're having more left-leaning governments come into play, and so the risk is starting to increase. All of Africa right now, most of the stocks are undervalued. Investors do not want to invest in Africa, so the stocks are pushed down right now, their valuations. Do we know if investors are going to go back into Africa? This is all of Africa, South, Central, East, and West. All 4 locations right now, if you invest in a company in Africa, you have to understand that there's an investor are going to limit the upside of those stocks right now. You're not going to get the full valuation. And then when you're looking for mining friendly, I want to look at what is the political and environmental risk. Today there's a lot of ecological resistance, so you have to recognize that, and you want to limit your exposure. For example, you just never know. Right now we're seeing more ecological resistance in South America. We're seeing it in the Philippines. We're seeing it in Indonesia. Even in Alaska right now, we're seeing it with the pebble mines, significant ecological resistance. So you have to look at that. You also want to look at the countries that are more permit-friendly, how long it takes you to get permitting. Countries that are going to increase taxation or they're going to leave taxation where it's at. It's one of the reasons why I like Canada so much, because I think that permitting and taxation is supported. I think infrastructure support's very important, and Canada really supports that. So you're looking for resistance. What kind of resistance are you up against? It's very important to understand the whole location thing. So that's how I look for red flags. So that's one of the areas. So you mentioned so I want to talk about that. So go ahead.
Yeah, I completely agree. I think the biggest risk besides, actually mining risk, getting the mine into production, and management risk where the management team, could screw up the share count or they pay themselves too much money and then, don't progress the deposit fast enough. I think personally the biggest risk is geopolitical risk because, as these politicians, as they see their tax receipts declining, they're going to start, trying to look for additional revenue streams. And I think in Obama's budget presentation for 2013, I think he already tried to do this where he was debating actually going after a higher percentage of some of the mining companies and resource companies in the United States.
Yeah, that's the one thing about stocks, mining stocks, when you're going down, especially in the juniors, but also in the mid-tiers and the majors. Yes, geopolitical risk is real. We could see increases in taxation. We could see significant increase in energy costs. All these are going to impact it. But on the whole, I think the upside potential is there. So believe it or not, I'm almost 100% invested in gold and silver related assets. So even though I see the risk at this point in time, until we get this, what I consider this bubble, this mania bubble, until it actually takes place, I'm going to stay invested. But I am going to start taking money off the table. Once silver I actually have a plan in place, and I talk about it in my book. Everybody should have an exit strategy exactly for this geopolitical risk. I'm going to start taking silver off at 75. So it's 75, 100, 125, 150. Each step I'll be taking some money off the table. I'm not sure what I'm going to do with it, how I'm going to reinvest it, because now everything has a lot of risk, so it's hard to know where to put your money. But that's for silver. For gold, I'll also begin to take some off, but probably not until about 2,500 gold. So yeah, you have to have an exit strategy to kind of understand this geopolitical risk that could very well happen. So yeah, that's definitely true.
Yeah, I think the politicians might will probably try to do something for gold go after it, like with windfall profits taxes. I know Jim Rickards talked about that in his Currency Wars book, but I'm not sure what they would do to silver. But what I'm seeing, though, with some of the other smart money, some of the larger money managers who have a lot of capital, is they've actually been buying a lot of physical platinum because, platinum is more of an industrial metal. So I think what people like Kyle Bass and even a Federal Reserve president recently came out, they're buying physical platinum. And I guess it's because I don't think they think there's going to be, a windfall profits tax or any kind of confiscation risk with physical platinum.
Well, I see other risk involved in platinum. I don't see confiscation as an issue myself because one of the reasons why they confiscated gold in 1930 was for inflation, to inflate things. They couldn't inflate it. That's no longer an issue. Also, I think gold is a global commodity now, and I don't think America's isolated. I think we have a global economy. So I'm not concerned with that. The only thing I'm concerned a little bit with gold is taxation. If we're making a lot of money, I think that they could probably increase the capital gains in the United States. I think that's a higher risk than confiscation.
Well, we could talk, for a lot longer, Don. And this sounds like we should definitely have you back on in the very near future to continue the discussion on other global macroeconomic topics besides just gold and silver mining stocks. So thank you very much for your time, Don, and we'll definitely have you back on very soon.
Appreciate it, Jason. Thanks for having me on.